at a time where, yes, we've had some uplift in the uranium sector, but you know, the best is actually yet to come in our view.
Hello and welcome to Assay TV. Today I'm talking with Guy Keller, who is commodity analyst at Tribeca Investment Partners based in Sydney. Guy is also the portfolio manager for the Nuclear Energy Opportunities Fund. Guy, great to see you here today. I'd like to start off by talking about the Nuclear Energy Opportunities Fund that you run there for Tribeca. Uranium has had a bit of an uptick in price this year, up to about $30 or so. Not quite back up to the highs of 60 that we saw in 2011, but on the right path. How's your fund been performing?
Thanks, Leo. It's good to be here. Thanks for having me. Yeah, so we launched the Tribeca Nuclear Energy Opportunities Fund just over 2 years ago in response to some work we'd done around the fundamentals of the different commodities. The market capitalization of the uranium mining space was a little bit too small for us to get proper positioning in our flagship Global Natural Resources Fund. You know, it's been a longer journey than we may have thought about 2 years ago. There's been lots of reasons for uranium not to move. We saw that obviously start moving in April this year. And it pushed through $30, settling just shy of $35, and it's had a little bit of consolidation. Our fund, after, as I said, 2 years of being sort of sideways to lower, has responded extremely well. We're up strongly for the first 6 months of the year, and in fact, July that we've just completed here, it looks like it's probably around just over 30% return there as well, and that's at a time where, yes, we've had some uplift in the uranium sector, but you know, the best is actually yet to come in our view.
And how many companies do you have in the portfolio?
We aim to hold roughly between 10 to 15 positions. It sounds reasonably concentrated, but when you look at the listed opportunity set of the space, is around 50 odd. So it's actually a little bit more concentrated than that. At the moment, we'd be at the upper end of that, where I think it's about 15 or 16 positions, and that increased obviously through April as there was a reason to start buying some of these other companies.
And are you looking at producers only, or do you look further down the curve towards the exploration end?
We look at the whole sector, so not only uranium miners, but service providers around the nuclear and uranium mining industry. We can also have the ability to look at nuclear power generation and that. So it's the whole sector. At Tribeca, our specialisation, our wheelhouse, if you like, is more around the mining. So that's where the main focus is. And we have a bit of a concentration at the moment towards spot sort of proxies and brownfield projects that we feel will come on in the next wave of producers to come to market, but there is a tail of explorers and others that we do look at as well.
And what's driving the uptick in the uranium price at the moment?
Well, quite simply, you know, I mean, I hate to say that COVID was the catalyst. I think it's sort of COVID shone the spotlight on the concentration of supply to a handful of producers, and when you had both Kazatomprom, the biggest producer in the world out of Kazakhstan, and Cameco, the biggest producer in the world, biggest Canadian producer, both basically put everything into care and maintenance. That shone the spotlight on the market that there was actually a real problem, that you had more than 50% of monthly supply suddenly offline.
And how are the sort of China is building a lot of nuclear reactors? How is that program developing?
I mean, the last 3 years, I think China have connected 12 reactors to their grid successfully. And that was after a period of slow progress. And as a result of the successful connection, they approved a whole bunch of new reactor builds last year in 2019. Our view was that those reactor builds approvals were delayed because largely the 12 reactors they connected were new technology for Chinese reactor builders and a bunch of different reactor designs. and now that they've been able to prove that concept that they can build these things on time, on budget, and safely connect them to the grid, they're going to continue forward. They've been slow, obviously, in this year, 2020, due to COVID-19 and related sort of disruptions in announcing new builds. But our view is for them to keep with their current 5-year plan and what we think will be in the next 5-year plan. They need to be approving 6 to 8 reactor builds per year, infinitely.
Mm. And what's your take on where the uranium price might go from here?
Oh, look, I mean, we've got to just shy of $35, and we haven't seen any real activity from the buyers, being utilities. All of the activity, or sorry, not all, but most of the activity we've seen in the markets to date has been Cameco covering some of their commitments, their sales commitments, because they're shortfall because they're not producing. And traders covering short positions and getting themselves along, and that's seen the uranium price move from the mid-20s, where it sort of sat for a while, to just shy of 35. So seasonality sort of kicks in for the end of the year for utilities to start looking at their fuel buying programs, and so our view is that it should push through $35 fairly easily coming into the end of this year. What happens then is a function of how much material is actually available to them in that market.
Yeah, an interesting market to watch. I mean, another sector that's obviously performing pretty well at the moment, gold, up closing in on $2,000 an ounce. What's your take on where that price might go?
Well, I mean, we were bullish again as part of one of the results of COVID. We started getting towards a bullish gold thesis there, a little bit defensive for us as well at the time, which turned out to be the right move. We've seen the dollar roll over structurally, the US dollar that is, and that's obviously helps gold. So we remain bullish. We dramatically increased our positioning in the main fund, in the Global Natural Resources Fund, to a gold exposure, and that's paid off well so far. A little bit of wood to chop here at $2,000 an ounce is to be expected, I think. But whilst the dollar remains structurally bearish here, whilst yield is extremely hard to come by, and whilst there remains a lot of geopolitical and other reasons for owning gold, we think that it should move forward again coming into the third and fourth quarter of this year.
You said you increased your exposure to gold in the main fund there. What proportion of the fund are we talking about that's dedicated to gold?
We're upwards over sort of 30+% of the fund now is sort of the precious metals exposure, and it was a little bit higher. We took a little bit of that off. I mean, some of those positions we thought had run their course for the time being, so we sort of turned them over just as a bit of a trade there. However, we still are looking at stocks we like and accumulating a bit more on the dips there.
And typically for the main fund, what sort of size of company are you looking at? What stage of development?
Yeah, look, again, it started for us in the larger caps, and our view was there that more generalist money would chase into those sorts of names as they were looking for a little bit of defense or exposure, and that's moved down. We've moved some of that money down into the more explorer. I mean, there's obviously been probably the busiest period with respects to raisings and activity and drilling in the West, a little bit down in Victoria, some in Canada as well. And so there's been a huge amount of market capital activity there, which, we've been around these markets for plenty of years. We know a lot of these companies and the brokers who are doing the banking. So we've taken full advantage of that as well.
In terms of inflows, how are your investors reacting to the current sort of positive news coming out of the mining space?
Yeah, that's a very good question. I mean, obviously, resources over the last 18 months have been a tough place to be an investor. There's been a huge amount of political interference with respect to trade wars, and not just between the US and China, but between seemingly every country. And so fundamentals around, and you've seen a correlation of one where almost every resource sort of related investment either goes up or down in lockstep. So, it had been a tough space, and I think certainly broadly across the space there was net outflows. With COVID again, you're not seeing a huge amount of new money come back in to the space yet, but I think that's more indicative of all investment spaces. However, certainly with us, our fund flows have been very sticky over the last quarters. I mean, the June quarter for our Global Natural Resources Fund has been one of our best quarters in about sort of 4 or 5 years. So, it's indicative of when this sector turns and wants to perform how it should, you can very quickly capitalize on that.
Absolutely. I mean, you mentioned the trade difficulties at the moment. Iron ore in Australia, obviously very reliant on the trade with China there. How are you seeing the iron ore space performing at the moment?
Oh, look, again, when it became clear that China had solved a lot of their COVID community transmission problems well before, as the rest of the world seemed to be catching COVID, we then sort of focused on which commodities would benefit from just China. So it didn't necessarily matter so much what was going on in the rest of the world. Iron ore was a clear outlier there for both the reason of if China was to pull a stimulus infrastructure type lever, that would be beneficial to steel. And also, Brazil supply issues became front and center there as well, with Vale reporting issues around COVID management there as well. I think so. We were bullish to iron ore. I think a lot of the consensus in the street has tried to call the top in iron ore, and yet the steel numbers out of China continue to impress. So, we can almost see a little bit of a period like last year where, everybody was looking for that turn in iron ore, yet the steel numbers were just extraordinarily and surprisingly strong. I think the latest steel numbers out of China were annualizing well over 1 billion tons of steel, which is a year-on-year improvement to last year, which was a strong year. So, we remain constructive to, especially the Australian iron ore producers. They are in a fantastic position. I don't actually subscribe that to the point that there's a problem between Australia and China with respect to trade. I think there's, it's a marriage of convenience, not a marriage of love. We need China as they need us. Iron ore is important to their recovery. So whilst they might make some noises around some of the more minor commodities, I think that relationship with iron ore and China remains intact. Absolutely.
And as we come out of the COVID situation, what impact do you think that all this sort of stimulus spending will have on the commodities sector?
Well, I mean, we're already seeing some of it, right? We're seeing some of the commodity prices run ahead of the demand return, and I think that what you need to remember as well is that yes, this has carried on longer than I think a lot of people thought would be possible when we're looking through how quickly China recovered. But the reality is that the demand, it's not structurally broken, as it may have been in 2008 in the GFC, where the banking system, the financial system was structurally broken. This has been just, the rug's been pulled from us in a hurry. And as I said, as we're seeing from countries like China who are pushing through this, and some other countries, that demand can return quite quickly. And so when you are in a position where you already may have a structural deficit in some of these commodities, and you've got a huge amount of liquidity floating around in the system, it can only be, it's bullish at best and it's supportive at worst.
So your take on where we're going to be sort of towards the end of this year, the metals and mining sector is sort of set to continue to perform well, do you think?
Oh, look, I think so. I mean, obviously we've got a US election, well, maybe. It looks like it's still going ahead. So there is some still political and macro pressures that we might find there. But I think one thing is clear in the United States is that they've got no choice but to try to push through this, as have a lot of other countries. China are trying to return to normality, and that is doing well. And you haven't even seen other countries like Europe or India, for example, who've been affected. They're still having to return. Japan, Korea have been sort of a little bit stop-start and slower than maybe some thought possible. So there's a lot of demand that needs to return in the next 6 months that can't afford really to have large-scale shutdowns that we saw at the beginning of the year.
Absolutely. Well, thank you very much, Guy, for joining us today. That's been very interesting to hear about what your funds have been up to. Good luck for the rest of the year.
Thanks, Leo. I think it's going to be a real interesting next 6 months across the whole sector. So strap in, and hopefully we all come out on top.
Absolutely.